Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is an expert in oil, energy returned on energy invested, and mining stocks. The mining industry covers costs about like the price for a giant earth-moving tire. I was reading articles about this on Financial Sense from him over 10 years ago. Steve St. Angelo, thank you for joining me again.
Well, Jason, great to be here. I don't know if I'm an expert, but what I like to dig into things. So I do a lot of research and I find a lot of very interesting things that are happening. And then when you look at them and put them all together, you see a much different picture than people who tend to just focus in one specialization. And I think that's what I like to do. I like to see how it all connects together, especially with energy.
So we're recording this interview on Wednesday, March 15th, 2023. The West Texas Intermediate crude oil price is below $70. I think you said it was around 66 at one point earlier today. Brent crude's under $75 a barrel. Natural gas is under 2.5. It's been a wild ride in natural gas the last 2 or 3 months. But recently, Steve, last week, we had comments from the Pioneer Natural Resources CEO. The guy's name is Scott Sheffield. He said some really interesting comments about the Permian Basin, which is where almost all of the global oil production growth the last 10, 15 years, and also the overwhelming majority of the US's annual production growth came from. He said that the US won't reach a new record in oil production ever again. And why do you think the production in the Permian is starting to slow down?
Well, there are many reasons, but it's due to they say it's technological improvements that have been made producing oil more efficient. That's not really the case. What they did is they did fracking on steroids. They started off with very short laterals, about a mile long, and they did 15, 20 stages. And most of this was started in the Bakken in North Dakota. And then as the industry went on, they didn't make really any money. No one really made money, up until 2019. It was a losing proposition. One of the reasons why was one of the major components is the natural gas was dirt cheap. It was like around $2 plus or minus. And for a decade, even though there was some spikes up and low. And so that you were just giving that away. And so unfortunately, they started increasing production, especially after 2016, when the oil price started to recover. And they went to 2-mile laterals, 10,000 feet. They went to 30, 40 stages. And then they started shoving in a lot more water and sand. And so you get a lot more oil. Unfortunately, the decline is even greater now. So you're adding production, it's growing now, but the declines are more severe. And each year that goes by, Jason, they're going through their drilling locations, because just like anything else, these drilling locations aren't unlimited. And so when you reach a certain amount of drilling locations, that tends to be the peak of the production in that region. And we're seeing that in the Bakken, we're seeing that in the Eagle Ford, and we're seeing that in the DJ Niobrara in Colorado. The only place that's left right now is the Permian, and especially it's the New Mexican Permian. And so what's happened is they've done a little bit less wells in last year in the Permian, but the production per well is declining, and the decline rate is still very severe. And so that's what's happened. And so now, even though the wells are still increasing, the production is rolling over. And that's what we're seeing in the top 8 companies in the Texas Permian. Production is starting to roll over. And this happened in the Barnett. This happened in the Fayetteville shale gas fields. They rolled over. And so this is just the inevitable conclusion to the shale boom, which is now starting to peak.
So for our listeners who are not familiar with the shale boom, it started in 2008, 2009. Hardly anyone was talking about it. There was the Fed went to zero interest rate policy, quantitative easing. I would argue that a lot of capital and resources, malinvestment went into shale, pension funds, private equity. There was a lot of sharks there. The investment returns for a lot of these drilled wells were not good. These companies were not generating free cash flow. They're growing. They were actually operating, Steve, these oil companies, and they have capex and drilling. They have to put a lot of money back into drilling to maintain oil production or natural gas production. So they were actually running very similarly with their business models to these Silicon Valley revenue-only technology companies that were claiming to be technology companies. So they were just growing oil production and growing revenues, not focusing on profits or free cash flow. And that's how the US was able to keep growing its oil production from basically about 2008 to 2019. And the majority reason, like you said, was the Permian Basin there, which had a lot of sweet spots and the lowest costs of all the shale wells.
Yes, and so now when you look at what's happening, and so I had mentioned the fracking on steroids, and now I'm noticing this in the Bakken, uh, uh, that companies like Hess are starting to do 3 mile laterals. They didn't do that last year, and Hess is a pretty good company. And now Hess, in the first month in 2023 in the Bakken, is doing 3 mile laterals. And so there's other companies doing 3 mile laterals in the Bakken, and they weren't really doing that before. And so it's cost is a little bit cheaper, but then there's more issues, technological issues with having a longer lateral. You've got to really shove a lot more pressure to get down all the way. And so now you've got 50 plus stages. And so they're doing the same thing. Pioneer had almost 50 3 mile laterals last year. That's what they did. We're talking 15,000 feet. That's how long these laterals are under the ground. Pioneer said it in their fourth quarter. They're going to do 100 3 mile laterals. So this is a continuation of fracking on steroids. And so now they're going with the 3 mile lateral. And so this is another way to get more oil production, to keep the declines really start to kick in. And so we're going to see, we may see a continued very slow move higher in production in the Permian, especially coming out of New Mexico. But Texas can kind of stay up there for a little while. But all of a sudden, I think in a year or two, Jason, it's really going to start to roll over. And again, we don't know what the side effects are going to be with this banking crisis. We've seen what's happening with the energy prices. And a lot of that profit that these companies were getting was that natural gas, which I think Pioneer, they got about $5 in the fourth quarter. That's what they got, $5 for natural gas. Now it's in half. And so they've lost all that profit. And then I think the oil price is down $15 right now, what they paid, what they got less. So they're losing a lot of profit now. And so this is going to continue. So I think moving forward, what's important to understand that the Permian, New Mexico is the last growth area. Once that is done, then we start to see the decline in U.S. shale production. And unfortunately, that's not a good reason to own these shale companies, because the only reason you own them is if they're good growth potential. Why would you own a company that's is beginning to go out of business, even though you get a high oil price? They're just going to have less production going forward. So this is a dynamic. People say we need to get in oil. There are companies that are probably good to be in, but a lot of the shale companies, in time, they're going to just have continued declines in oil production. And that's not good for stock prices.
Well, I see forced mergers and acquisitions. So there will be share dilution. So the consequence will be share dilution. So to maintain production growth for oil and natural gas, there's going to have to be forced mergers and acquisitions, because I don't think there's going to be the capital available that there was in the past. Some of these companies did have free cash flow, like you said, at the higher natural gas price. If they kept cash on the balance sheet and they didn't pay it all out in dividends, they could go and do some acquisitions now and buy some assets cheap and grow production that way. But the decline rates, we were discussing this before we started recording. There's a chart out there from Callon Petroleum. So they're one of the lower cost producers in the Permian there in the Delaware Basin, which is a specific area of the Permian. And they were just showing the decline rates for some of the wells. I mean, they were bragging that their decline rates, Callon Petroleum, are around 60% in the first year or two for their wells, and their competitors. So like the Pioneer Natural Resources, EOG, Devon Energy, their decline rates are well above 60%.
Yeah, I've gone through in the numbers, and I'm able to do that because I subscribe to Shale Profile, which is now Navi, and they break down all the companies, all the wells individually. So I can see a lot of interesting things going on. And for example, Pioneer, if you look at 2018, its wells in 2018 suffered a 68% decline rate. And then, so if you look at them in the last 5 years, it's between 67 and 69%. And so that's what their first year decline rate is. Now, I sent you a few charts, and what happened with Pioneer, and this happened with the top 8 companies in the Permian. When you look at the Texas Permian, and I'm talking about the Texas Permian now, I've separated from New Mexico because New Mexico is going to continue to grow. The Permian to me is in the peak, it's in a peak plateau area now. When you look at the well profile and how many wells they've been adding, and they've been going up at about a 45-degree angle ever since the pandemic shutdown. Well, you've noticed the top 8, it's like a dome. The production is not going up in a 45-degree angle as it was from 2016 to 2019. It was going up. It's similar. If you look at the well profile, how the wells were adding, going up 45 degrees, the production was going up the same. Now the wells are going up still about 45%, but the production is like a dome. It's rolling over. And I noticed that with Pioneer, and I did the numbers. If we remove Pioneer's 2022 production and look at what happened from 2021 for a year, from November 2021 to November 2022, that production declined 224,000 barrels per day. That's how much. And it hit 495. So it fell 45%. And that's typical when you stack all the oil on top of it. It loses about 45% a year. The United States shale industry loses about 45%. And so if you're producing about 8 million barrels, you're losing about 4 million barrels a year, just about. And so when Pioneer added its new production in 2022, just if we look at 2022 all by itself, 483 wells, it reached a peak of 217,000 barrels. Well, if your decline is 224 and you only add 217, well, guess what? You're not going to grow. And that's exactly what happened with Pioneer. Pioneer's rolling over. So if they want to grow, they're going to have to do 600 wells, not the 483. And that's the only where they're going to grow. But guess what? They're not going to do 600 wells. They're going to do 500 something, and they're going to do more 3-mile laterals. We may see production improve a little bit with Pioneer, but if they want to keep growing, they got to go 700 wells. Then they got to go to 800 wells, and they can't do it. This is the reason why we're going to see the decline in the Permian. New Mexico is coming probably in a year, but that's the reason why the big Texas Permian is already in plateau mode.
Didn't Chevron say in the last 12 to 18 months that they're going to also grow production in the Permian, but it's going to take them 5 years, and I think they're only going to grow 10 or 15%. It's not a massive number in terms of growth. And the CapEx bill. So what the average person listening to this doesn't understand, yeah, it sounds like they're going to grow okay over the next 5 years, but they have to put many billions of dollars of CapEx investment in just for a small growth percentage now.
What's interesting about Chevron, from what I understand, Chevron is an outlier because they have a lot of lease acreage in the Permian that they don't have to pay the 20% royalty. So they don't have to drill these wells in a certain period of time, because if you don't drill and complete that well in a certain period of time, you have to. This is
you lose the land. You lose.
That's correct. So Chevron, I think what Chevron is doing is they want the rest of the companies to blow through their reserves, their drilling locations. And they're going to continue to add, wells and complete wells and keep production going. But I think Chevron, due to this reason of not having to pay the royalties, they're going to come back when a lot of the companies are in a big decline. And they're going to have the acreage there, and they're going to take advantage of it later on down the road. So that actually makes sense. That actually makes good strategic sense for Chevron, but Chevron is one of the few that can do that.
What I'm also seeing, Schlumberger reported earnings about a month ago for the annual report for 2022 and Q4 2022. And what they said is that you were talking about how they have to do larger amounts of drilling to maintain production, to slow down the decline rates, and the size of the laterals is increasing. They're saying that they're going to have to raise prices for drilling because demand. So they're going to have to do they're going to have to go and hire workers that were in construction. They're going to have to hire them back. They're going to have to offer them higher wages to at least partially offset some of the inflation that people have been dealing with. They're going to have to raise prices substantially to complete wells and also for other oil services because of the supply chain issues. So I think the point I'm trying to make is that I don't see a lot of cost cutting for these oil and natural gas companies. Even though the prices are falling, it's going to be very difficult for a lot of them to figure out how to cut costs with higher interest rates. Cost of capital is higher. And then also the service companies, which do the drilling for them, they're raising prices substantially.
Well, and we're seeing this with Pioneer. Again, Pioneer is the largest producer in the Permian, and so what's happening with them is a pretty good indicator, like Barrick and Newmont in the gold mining industry, and Fresnillo in the primary silver mining industry. And so, what Pioneer plans to do is their capex is 4.5 billion this year, and when a company reaches $1 billion a quarter for their capital expenditures to produce this shale, this is usually the peak. This is usually, and I'm not talking about like Exxon, but I'm talking about just shale only companies. This is usually when they hit the peak of production. And so $1 billion a quarter and doing probably 520 wells, they're going to try to get back up to their previous peak, about 500. I'm not quite sure. I've got the data right here. Let me just look at this number. Yeah, 350,000 barrels a day. They hit 354 in quarter three. They hit 350. It fell in quarter four. Now they want to try to get up to 355 or 360. And I mean, this is not much, folks, because in the fourth quarter of 2020, well, they did purchase they purchased Parsley. So, but they're increasing production, but it's not that much. The actual production has been declining because in the fourth quarter they were 393. Now they're at 350. In the fourth quarter of 2021, I don't mean to confuse you. In the fourth quarter of 2021, they were 393,000 barrels per day. Now they're 350. And so the issue is they're going to try to get up to 350, 360, but they're not growing. You go back to 2018, they were 172,000 barrels a day. And so even though they purchased a Parsley, we could see that their growth is over. They're just trying to replace declines now. And that's all the shale industry is trying to do, is just replace declines. And pretty soon, just like the rest of the world, they're not going to be able to replace these declines. And so I think that's the issue going forward. And unfortunately, I think we're going to see lower capital costs. But then that's going to come back, Jason. The lower capital costs are probably going to happen in the third quarter, third quarter. But then the price is going to go back up again. Supply shocks again. Prices when the Fed pivots. And then we're going to see inflation, higher capex. And that higher capex is really going to be the death knell of the shale industry the next time it comes around. But I do think we're going to see weaker capital prices for a little while. But then it's going to come back again in the end of this year and into 2024.
You mean when the Fed lowers interest rates again and starts doing a new liquidity program, whatever the new liquidity programs are going to be called, no loss for taxpayers or something?
Yeah, and you see, I get why they're doing it, because I call it the energy cliff. The reasons, the problems we had in Europe with the high natural gas prices, it was before the Russian-Ukraine war. It was the world hitting the real peak. And this is like unconventional too now, and not the peak of conventional, which happened in 2006, 7, which is why the oil price went to 148 in 8. Then we had the low interest rates, like you said, QE, and then we brought on the crappy unconventional. And so that allowed us to go to Walmart, Walt Disney and Starbucks for another 15 years. But that's going to peak now too. And so we're waiting for the peak of unconventional. And then so now we're at this energy cliff dynamic. So they're trying to keep demand down, or inflation would have really, we would have seen 150 oil if they didn't come in and try to kill demand. Because look at the price of airplane tickets. The airplanes are full. And so, the only way you kill demand is you raise interest rates high enough. And now that's causing a lot of problems in the banking industry. And so now we're seeing a decline in energy. And then pretty soon it's going to get really bad. A lot of the problems in the financial system, and then they're going to turn around, and then it's going to be the QE again and lower interest rates. And that is going to be, I hate to say it, the death knell, because we may see in this next, I call it energy cost push inflation, the next round. And it's not going to happen quickly. That could be 4 quarters, 6 quarters or more. Then you could see $200 oil.
Well, Biden also dumped around half now of the strategic petroleum reserve. So, and they're claiming that they might refill it soon, but I don't think they will. I think whoever's in the White House after Biden will be stuck with this mess.
Yeah, and even though we had the financial crisis in 2008, and it really, that was pretty bad, right? Demand for oil only fell 2 million barrels a day by 2009. That wasn't much. It wasn't like the pandemic where they shut down, it was like 12 million barrels a day, 15 million barrels a day initially. And so now, even though we may get a decline in demand due to what's happening, we're getting low prices, and that's killing a lot of the shale industry. It's going to start killing a lot of the shale industry. And so then supply is going to start to fall. And then, you're going to have the, supply and demand problems, and price is going to start going back up, especially as they do pivot. And so I think Jason, to keep it simple, stupid KISS principle, the energy cliff now that we've reached, because this is what I've said, we had a lot of geopolitical events in 1960s, right? We had the Cuban Missile Crisis. We had Russian nuclear missiles in Cuba, or going to Cuba, right in our backyard. And that was in 61, 62. And then we had the Vietnam War in 65. We had the assassination of Martin Luther King. We had the assassination of JFK. We had the assassination of Robert Kennedy. All these geopolitical problems. Do you know what the oil price did? It remained $1.80 from 1961 to 1970. It didn't fluctuate at all. No volatility in energy prices. But what happened in 1970? The United States peaked. And then we had all the problems with the Middle East oil shocks in 1973 and then 1978. And then the prices of everything just went up. The inflation and and metals prices, gold and silver, all went up. Well, we're now at the level where that was due to the Middle East actually curtailing production. Well, we don't have that problem anymore. We just don't have the production. And so now when we hit this energy cliff, that's the reason why the prices are so volatile now. Not like they were, because we were adding so much oil in the 60s. We had too much oil, really. Now we don't have enough oil, even though we could.
The Saudis have increased production a lot over the last, 18 months, and they've maxed out capacity. A lot of these OPEC countries, they actually ran on the red light, and the Saudi oil minister just said in the last 2 months that there is no more spare capacity. So if China comes back online and people in China start driving for businesses, driving to and from work, flying either for vacation or for business or work, the oil consumption, gasoline, jet fuel consumption, it's going to erase a lot of the spare capacity very quickly.
I don't disagree with you. I agree. And another issue that we tend to be overlooking is that 20, 30 years ago, OPEC and the Middle East was a much higher percentage of overall oil production than the global oil production. Now they're a third. It's not OPEC. That's where all the growth really came from. Even though we've seen increases in Saudi Arabia recently, the growth in the last 2-3 decades has mainly come from non-OPEC. And a lot of that's deep water, which is expensive, and shale, which is really expensive and declines at 45% a year overall, even though individual wells and individual years, it's 68, 70%. And so the one factor that I'm very concerned about now, I call it the Red Queen syndrome. Maybe you've seen this. I have calculated that the annual decline rate, the natural decline rate that the global oil industry is suffering is between 10 and 11 million barrels a day lost every year. This year, next year, we're going to lose 10, 11. The year after, we're going to lose 10, 11 if we keep the production this high. And we've got to replace that. And we have been. And so, 4 of that 11, 10, 11 is the U.S. shale industry. And so when you add up all this, we have reached the Red Queen syndrome, and now these declines are going to really start to kick in. And I think this is why what I'm saying is the energy cliff dynamics are going to have extreme volatility. And I've said this, high oil prices and shortages and natural gas prices and shortages like we saw already. And then it's going to swing the other way, and we're going to have surpluses somewhat and low prices, and then it's going to swing back the other way. And volatile prices are not good for the energy industry or the economy. It's stable prices. And so this is where we're headed, Jason, and it's going to be very difficult as an investor to try to invest in this kind of world, or a company to try to keep business in this kind of crazy volatile world.
So you said that about 11 million barrels per day per year needs to be replaced. In 2022, an average of 11.9 million barrels of U.S. crude oil were produced each day, just below the record average of 12.3 million barrels per day set in 2019 at the very top of the shale bubble.
Yeah, I'm including oil, condensate, and natural gas liquids. That's the number right there, because that's what the total petroleum liquids. Even though natural gas liquids are not oil, we produce a hell of a lot of those. It's like 12, 13 million barrels a day of natural gas liquids in the world, and the United States is half of that. And that's mostly that's from shale. It's just about. And so when we figure that the United States was 80% of global growth since the 2008 financial crisis, that's where all the growth in the world has really come from, is from the United States. And that was a boom and a bust, even though the bust may take a bit of time. But once we start going down, it doesn't recover. And there's really nothing else to make it up. There isn't shale 3.0. And even though there's other shale fields around the world, according to the USGS and the Goring and Rosenzweig, they did a great analysis on this, that the USGS, there's like 10 top shale fields. This is a real profitable shale. 7 of the 10 top shale fields in the world are in the United States.
Yeah, I know there was hope for shale in China, and that failed. So they spent a lot of money on drilling, trying to frack those out, and a lot of the wells were misses. I just saw an article on oil price yesterday. Argentina's YPF looks to double oil production within 5 years. So the headline looks great, except that you looked at YPF, their largest oil producer in Argentina, only produced 232,000 barrels per day of oil. So doubling that is not going to offset the Permian Basin.
No. And I think the issue is this too. I call it the falling energy return on investment. And I've been seeing that. And, it's no coincidence that oil sands out of Alberta, its energy return on investment is a pathetic 4 to 5 to 1 energy return on investment. And why is that the case? Well, I don't think people realize this, and I was kind of stunned until I found out. For every million barrels a day of Alberta oil sands production, they have to burn 1 billion cubic feet a day of natural gas and in the mining and the in situ production. And so they're producing about 3.4 million barrels a day of oil sands. They're burning 3.3, 3.4, 3.5 billion cubic feet a day to produce that oil sands. Well, if you understand the energy content of natural gas is Oil is 6 times greater. So that's the 6-to-1. You're burning 1-to-1 natural gas to produce this oil. That's the 6-to-1 EROEI. And so there are other issues. And that's coming due to the shale gas field in Western Canada, the Monterey. And so they're doing shale gas production that feeds the Alberta oil sands. So if that gets into trouble, then how are you going to? So even though there's this idea, there's all this oil.
It sounds like the production can't, sorry to interrupt you, Steve. It sounds like the production can't come offline then. So we can't eliminate the oil sands. We can't eliminate deep water. We're going to need these things to replace the Permian Basin oil production that's going to fall off a cliff soon.
And it's, many other, we're seeing declines in many countries. More and more countries are added to the decline list. It's just more and more countries are added to decline. And what?
Oh, Mexico. Yeah, Mexico and Pemex. I was writing articles on this for my paying customers, the patrons. Pemex now, Mexico's not a net exporter of oil anymore. There's been many years of increased domestic oil consumption. So they don't have that enormous super field, the Cantarell field. That's not a big bonus for them anymore, where they can keep easily growing production.
Yeah, and we're still finding some oil, which is nice news. Exxon's over there with Hess in Guyana, offshore Guyana, and Hess is now producing 118,000 barrels a day of that oil, and it's more than their Bakken production. But guess what? I think from what I've seen so far, it's 11 billion barrels of oil that have been discovered there. We use 30 billion barrels a year. So far, we got 3 months supply out of the Guyana. And then,
and that was the largest discovery in years, right? Or
that's the largest discovery. And then Biden just came out and, just passed the Willow project for ConocoPhillips in Alaska, which they say it's about 600 million barrels. The United States uses about 5 billion barrels of oil. We're talking that would supply us 45 days. So when you start realizing we've just run out of these reserves, and the problem going forward, and this is important for your listeners to understand, we've kind of propped up the energy industry with debt. And that's what happens when I was talking about the falling energy return on investment. As the oil energy return on investment has been declining, we're bringing on these other energy sources with lower energy return on investment. We had to add a lot of debt in the entire system to do this. Well, all that debt is overhanging. The problem I see, which we're seeing right now with this banking crisis, with the Silicon Valley Bank, which is more of a high tech bank and crypto bank, but there are companies that had a lot of money in there, and they're running, let's say, somewhat profitable high tech firms. Well, if they lose their money, what happens to supplying the money to run their company and their employees? They get into trouble due to this collapse of this bank. Well, when we start to see the collapse of debt, that means less capital is going to be available for the oil industry. And this is why I call it the energy cliff. We have brought on all this debt to keep business as usual with the falling energy return on investment. And so if that debt starts to implode, like we're seeing in this banking crisis, it impacts the real economy. And that means there's less capital that's going to be used to produce more oil. And that becomes a self-fulfilling negative feedback loop. And so that's when I think we could really see production come offline, because there's not going to be the capital in the future. And so this is, I'm not quite sure, Jason, how this plays out, but it's above and beyond what it costs to produce oil.
So if the oil price right now, and we're below 70 here in the US, if it goes to 50 or 60 for a couple months or 6 months or something like that, would you say that a lot of the production in the US and Canada, especially deep water and the higher cost unconventional stuff, it won't be economic anymore, right?
No, and deep water really isn't economic till about $100. Really, it's not really economic, or $80, $100. But they've done a lot of these, and And so the issue comes down to we use debt to continue funding the capital. And unfortunately, we moved some of this capital into renewables, green. I mean, actually, from what I heard last year, it was 50-50. Half of the capital of energy went into fossil fuels and half went into green. And and so that's not a good sign. Even, but the problem is we haven't been finding a lot of oil. We've been spending a lot of money. We're just not finding a lot of oil. I mean, uh, I did a chart on this. We found we're finding a fifth every year of the oil that we're consuming. So you're consuming 30 billion barrels and you're finding five or six, you know, and you're still spending a lot of money. You just don't have to be a rocket science to figure out we're not replacing these reserves. And so I think this is the problem. And again, on top of it, with the falling energy return on investment, all this debt now that's choking the entire world, as that implodes, the money supply implodes, and unfortunately, the capital expenditures for future production of oil is going to be limited, and that's really going to I call it cliff-like declines coming in oil production. It's not going to be a slow, gradual thing. I see a cliff-like decline, stabilization, cliff-like declines. That's how I see it, unfortunately, playing out.
And I think that's why a lot of these larger producers like Chevron, that Shell, they've gone to natural gas and liquefied natural gas instead. But unfortunately, a lot of these countries, they have oil and natural gas drilling bans domestically, and their politicians and other people running their governments are saying, we're going to build a liquefied natural gas import facility. Well, they're not investing the capital into new supply, oil and natural gas drilling. So they're going to spend billions of dollars to build a liquefied natural gas import facility without making sure that they can actually secure the supply.
And that's happening in the United States too, right? We're bringing on there's all these new LNG facilities that are going to come online in the next 5 years. We're not going to have the natural gas. The Marcellus is rolling over. The Marcellus, which is 25% of our natural gas, is rolling over. I'm not saying it's done, it's rolling over. And then if you start really getting declines, one of the things that's happening in the shale fields like the Bakken, the Eagle Ford, and the DJ and Alberta, and even in the Permian, is just, if you hear a siren in the background, that just is the energy cliff siren. But what's happening is we're getting more natural gas as the oil, more of a percentage of natural gas to oil. And so that's a problem because it's making the price of natural gas fall because we're producing more natural gas to oil. But at some point in time, when these fields really start to decline, the natural gas will decline with it. And I see that starting to happen in 2025, picking up speed in 2026, start 27. And then we're not going to have the natural gas LNG to export. We're going to need it. And what's even worse, we've cut down coal-fired plants and we've increased natural gas to be a balancing power to wind and solar. And we're setting up for what I call we're setting up for the electric major problems with the U.S. electric grid. And so that's still some years down the road, but I see it happening right now. I see the trend that we're heading towards. And so this is going to be a big problem for the United States and the rest of the world, especially Europe.
Yeah, European energy policy the last couple of years, it's been, well, that's the poster child is Germany, but I mean, it's been 10, 15 years of ESG policies and allocating towards wind, solar, and biofuels. Germany did not do solar efficiently. They took their nuclear power plants offline, and then they had to spend, I think, over $500 billion for this past winter just to make sure that they had the coal and the wood and the liquefied natural gas. They were grossly overpaying at sky high prices to make sure they had enough energy for the winter.
Yes. And so last year looked like death to Europe. And a lot of people, I was concerned. And I did mention in one of my interviews, well, it really depends what happens in the winter. And what happened in the winter? Well, it was the best case scenario for Europe. And it even happened in the United States and around the world. It was very warm. very warm winter. Green energy outperformed compared to the year before, and wind did well. And then they had a lot of natural gas coming from other areas besides Russia, and so and they cut back on demand. They physically cut back on demand of natural gas, and they got more LNG from around the world. So you put all that together, and Europe survived the disaster that was happening last year. But guess what? That was the first inning. So even though they survived it, and you should see the inventories now are so much higher. The inventories in Europe are 100% higher than they were last year. And in the United States, where our natural gas inventories are at the upper end of the 5-year average. And we're getting ready to go now into the spring, which is the building part. So I think natural gas is going to fall below $2. It may even get below $1.
I don't know about that, Steve, because we have the free. I just had another expert on a couple weeks ago, LEQ, and he was laying out the case that once the Freeport liquefied natural gas export facilities back online, and it's just started coming back online the last couple of weeks, that a lot of that natural gas inventory will be cleared out in about 6 weeks.
No, I don't think so. It's because it's only 1 billion cubic feet a day at the most. That's it. It's only 1 billion cubic feet a day that Freeport's going to use. And then that's not really good. We're producing 100 billion cubic feet a day. And so I think, and just to put some perspective behind that, looking at the forecast for European natural gas inventories, they're going to hit their limit if it continues in the same trend by August. And they're not going to need any more natural gas. They've never been that way before. What happens is there's the peak during about October, and then September, October, and then it starts to decline as they use more natural gas in the winter. They can't get enough natural gas. Due to the way it's set up now, and if we get a very slow economy and not a very warm summer, then they're not going to have any place to put natural gas really in about August. And the United States may be in the same situation. So I'm not saying this is going to happen next week or next month. I'm saying over the months, we could see very low natural gas prices. This is the energy cliff. This is how it works out. It's very volatile. It's very extremely volatile. And then it's going to come back the other way. And so when you get very low natural gas prices and you've got all the storage, let's say if the trend is you've got very full storage and you don't need it, what's that going to do to the price? And so,
well, the producers will shut off supply, and then the natural gas in inventory will be worked through, but then there won't be any more production to bring the supply back to fill the inventory back up. So then it's a boom and bust cycle. It's a shorter movement.
Yes. It's again, like I mentioned, from 1960, it didn't matter if the world almost ended with the Cuban Missile Crisis. The price of oil didn't go anywhere. $1.80 today, $1.80 tomorrow, we're going to shoot missiles off, $1.80, $1.80. No volatility. Now, due to this energy cliff dynamics, and you see, LNG is making the situation worse. It's not making it better, even though it's allowing our economies to use LNG around the world. I get that. That's fine. But this LNG now that's flowing around the world, it's just in time. It's just in time inventory.
Well, you got to blame the politicians, the bureaucrats, and the regulators in those countries, because they have the countries that are importing the most liquefied natural gas. They have drilling bans. So in their own country, so a lot of those people are not in my backyard types of people. So even though those countries might have the potential for a lot of oil and natural gas production, and I think there's a enormous shale patch under the city of Paris, actually, but it'll never be drilled. So there's a bunch of different examples of this where there are potential shale fields in the European Union. They're not going to allow it. So they're just going to have to import everything. So they're going to build these expensive liquefied natural gas import facilities, and they're going to expect that there's going to be some type of supply that they can import. I think that's unfortunately, the policy that a lot of these people in power in these governments have been implementing, they're still implementing it. They've doubled down on it in the last, if you go and look up like liquefied natural gas import facilities in the last Google search it in the last like month, there's all these new import facilities being announced too.
Jason, I don't disagree with you at all. But if we look at the example in the United States, the shale industry is going to give us about 2 decades, plus or minus, of life. So if we consider that, if the Europeans got smart and they said, well, we're going to do shale, they may get a decade and a half, and then it's done. So what do you do after that? And so I guess the thing is, I do agree with you.
Well, that's why I'm a nuclear power proponent, but unfortunately, I don't see a lot of countries heavily investing in that either. The European Union's taking nuclear power plants offline.
No, and I don't know. I don't know why they continue to do that. We see the Indian Point in New York still being decommissioned, and so yes, this is going on. I think where I differ from a lot of the nuclear proponents is that I would this is how I would clarify it. I don't, it's not smart to be decommissioning these nuclear power plants now, but nuclear is not going to save us because it takes very high tech equipment to make nuclear power plants. And so basically a nuclear power plant is nothing more than a fossil fuel derivative, the same thing as a wind turbine and a solar panel. And unfortunately, the global economy is not run on electricity. It's run on diesel. And you can't really transition that. And there's really no batteries that work for, moving chips and trucks and mining equipment and planes. You can't do batteries. So electricity is really not going to help us, even though it could have, allowed us to, have another decade or so. And so this is what it comes back to. The problems of energy were going to haunt us now, 10 years from now, or 20 years from now. So maybe I'm 80, but someone who's 20, at 40, it's going to hit them anyhow. Even if we scooped up and scraped up all the last energy we could, put nuclear power plants everywhere, the problem is we were going to hit these energy problems just like in the late Bronze Age, just like the Romans did when they ran out of good quality wood. We're doing the same thing. And so what's happened is this. And I'll conclude here. Even though scraping up more energy would have allowed us another couple of decades or so, I get that. I do agree. Politicians screwed that one up. But what the banks and politicians have done is use finance to keep the system going. And I think that's one thing I differ many in the alt media and the precious metal community. They look at the central banks and as the ills and the bankers as the ills of the world. I look at them as using finance to keep the lights on.
Yeah, they subsidized the shale bubble. I mean, it wasn't economic at all. They subsidized all this production growth. The pension funds were losers in this too. But yeah, they subsidized this. There was an enormous capital bubble that went to these shale companies. They were run similar to the Silicon Valley revenue-only technology companies that didn't have any profits. So yeah, they grew oil and natural gas production enormously. There was so much natural gas production, they were just flaring it for over a decade.
Yeah, and so if Europe did the same thing, I don't know how economic their shale was, even though it would have provided them some much needed energy they didn't have to import. So I think they would have fell in the same problems with the lousy economics of unconventional energy sources. That's the problem. And so when we keep it simple, stupid, we're using unconventional, low energy return on investment energy sources to keep the lights on. And to do that, you need the central banks in there with the money and the QE and the low interest rates to do all this. But now it's coming back to hurt us. And so we have to understand, if it wasn't for what the central banks were doing, even though Peter Schiff says if we get rid of all the bad banks and the central banks and go to free, real money, then we can have wonderful economic growth. No, because the energy return on investment shows we're heading for collapse and depression. And finance and economics and free money and real money doesn't solve that. Gold and silver are great things to have as an investment to protect your wealth, but they're not going to bring more energy out of the ground. And so I think this is a very fundamental.
Actually, I wanted to bring that up before we ended the interview. You brought up gold and silver. Actually, like I think mining is the cost of mining. It's not going to be cheap mining anymore. I mean, we're looking at every 2, 3, 4, or 5 years, the costs are going to keep going up. The grades keep falling. The copper grades have just, I don't know if you put a chart out on the copper grades recently. I know you cover silver grades and gold grades like I do, but the copper grades have just collapsed in the last 10 or 15 years. We're really scraping the bottom of the barrel here with this open pit mining. It's all arbitrage on cheap diesel and cheap energy.
Yeah, I totally agree with you. And this was a way, because people say, well, the mining industry just went into uneconomic gold because an open pit. We could have went into underground higher grade ores, and there are some there. There's just not a lot of them. And so I looked at the numbers. I looked at what the gold production was this year, 2022, and I divided it by the population. And I went back to 2011, took the gold production, divided it by the population. And you know what? It's the exact same ratio. It's about the exact same ratio. So we're just adding enough gold to keep up with the population. So that's supply and demand. And so you're right. To do that, we got to go to lower grades, open pit, burn. And I showed this in one of my last interviews, debates, that Fresnillo, their two gold mines, which is pretty similar to the other gold mines, they're consuming about 65 gallons of diesel per ounce of gold. And the silver mines, it's about a fifth of a gallon of diesel. So if we're looking at diesel only, I'm not talking about all energy, which is the electricity to mill the ore and all that. If we look at just the diesel, it takes 400 times more diesel to produce an ounce of gold at Fresnillo's gold mines, their two gold mines, than it does at their three silver mines. And this is similar to Hecla and Pan America's, some of Pan American's primary silver mines. So yes, it takes a lot of energy, Jason, to produce this gold.
For costs for these gold miners, do you really see a lot of gold mines that are going to be under $1,000 an ounce or even $1,200 an ounce for costs? I don't really see a lot of these gold mines that are economic at those that are going to have those low costs anymore. I mean, you just put out a piece in the last couple of months that a lot of the lower cost gold miners, the largest ones, some of their mines, their costs are $1,400, $1,500 or more now.
Yeah, and you see, this is my total cost. And I talk about that to subscribers. There is first of all, they used to do cash costs, but then investors started.
Those were a joke.
Those were a joke. And then they've gone to the all-in sustaining cost. Now that makes a bit more sense for gold mining than primary silver mining, because Hecla reports like a $10.50 all-in sustaining cost for their silver. Well, they lost money last year. How the hell does a company that reports a $10.50 all-in sustaining cost lose money if they got $22 for the silver and it's 10.5? The reason is because they're using byproduct credits to lower that. So unfortunately, the all-in sustaining cost, especially for the primary silver mining industry and the gold mining industry to a lesser extent, is not a metric that provides the profitability of the company. And so when you look at all the costs, I go by adjusted net income and the free cash flow. And this doesn't include the debt that has been added and the share dilution, that the real cost now for Barrick and Newmont last quarter, and I think I sent you a chart, is like $1,578. That's what it is, $1,578. It's the highest ever for Barrick. And so it
makes sense given what happened with diesel prices the last couple of years.
Yeah. And just, when diesel, and here's the thing, it's not just diesel, because labor is actually the larger cost. But you see, labor is energy. Right? People moving around, doing things, even though you may be sitting in a 400-ton haul truck, you are paid as a skilled laborer to drive that haul truck for 12 hours. So you're getting paid a high rate of labor to do that. So even labor is form of energy, and the materials that are being used in the gold mining industry that are extensive, those prices of materials are all based on energy.
Yeah, they have
And
to
then
be, a lot of them have to be mined. Yeah.
mined and refined. And so when you figure any material that is used, it's really a product of energy being burned throughout the entire supply chain, and finally to get it there. And then there's the capital of the equipment and the capital of the mine. All that's energy being burned in the whole process. And so this is the problem. Even if you got high energy prices, it's not just diesel. You got to pay people more because everything's going up in price. To keep these people, you got to pay a higher price for labor, and you got to pay a higher price for capital and a higher price for materials. And so this is the problem with the falling energy return on investment. It's impacting the gold mining industry. It's impacting the silver. And according to my data, Jason, 1550 is about the number for the fourth quarter when I look at the top 7 gold miners. About 1550. That's the break even. For silver, it's over $20. It's over $20. And then lastly, people say, well, Steve, that's primary. You're being disingenuous because only 28% of silver comes from primary, but the market needs that primary silver. However, okay, let's look at copper and KGM Polska, which is in Poland. Well, energy prices really shot up in Europe. Well, guess what? I just looked at their data. They pay KGM Polska, which produces a lot of copper and 40 million ounces of silver. They've had positive free cash flow for 13 years. On the last 2 quarters, they've had negative free cash flow. So guess what? That 40 million ounces of silver that they're going to sell in the market, they're not giving that away for free, which a lot of people have this silly assumption that the base metal miners are making all this money and they're just giving that silver for $5 an ounce. No, they need all that income they can get from that silver. So that's the reason why the primary silver mining cost of production of about $20 is equivalent now to what the base metal miners are getting paid, because it's all the same dynamics. So they're not really making any money on that 20 million ounces of silver that's going into the world. So this is where we're at, Jason. I don't see much lower production costs unless we have a complete collapse of energy prices where oil goes down to 20 and natural gas goes down to $1. Then yes, we could see the production costs lower a bit for a while, but then the energy cliff comes back to haunt us in the next 2-3 quarters, and it all goes back up again. And that's what's coming.
And we're not at $2 a pound copper. We're at $3.80 copper. So that's a pretty high copper price, but I guess it shows that the grades at these copper mines have collapsed. A lot of these copper mines that have been running for over 30 years. So they're depleted. The costs are up. The grades are down. So yeah, the mine's still running. But I mean, it sounds like to me, Steve, that a lot of these copper mines are barely break even now.
It depends upon what part of the world they're in, and this is what's an interesting thing about the mining industry. When they first started these copper mines and gold mines, the open pit was not that deep.
Oh, no one would have considered. No one back then, decades ago. I think the first open pit was Barrick Gold in the early 90s. I think they were some of the first miners doing it with copper and gold. And people are like, it'll never work. It's not smart. But I mean, like in terms of growing production, that was the only way to offset the gold production growth, all the depleted mines, especially with copper. I mean, we're really bottom of the barrel for copper grades.
Yeah, and then when you understand that as these mines age, they get deeper. And so when, let's say, you're going down a couple of 100 feet at the beginning of this new open pit copper mine or gold mine, well, to get back up, that haul truck is burning a lot less fuel. Even if it's going the same distance as in distance, how many miles it does on a trip or whatever. But now that these open pits are getting deeper and deeper, you got to go, it takes a lot more energy to go up and down.
Yeah.
So this is another factor. Even if the ore grades they're declining, but not a lot. The open pits are getting deeper. And that just uses more energy, even if the ore grades aren't declining. So these are kind of fundamental things that we don't even pay attention to.
Well, they're also with some of these companies, like I think Equinox Gold and one of their Brazilian mines, Arizona. I think there's underground mines. They're finding underground mines below the open pit now, but I mean, like you're going through, it's even deeper. So you're going to find maybe higher grades on the underground portion underneath the open pit, but then your energy costs are going to be through the roof.
Yes, and I agree. And one of the reason why I tend to be a little bit more of a, I hate the word to use bullish, but I like silver as a store value and a protection of wealth, even better than gold. Even though gold tends to get the highlight now because that's the knee jerk reaction. Problems with the banks, let's go to gold. I mean, you don't go to silver because that's like half of its industry consumption. So if industry is going to get into trouble, why the hell buy silver? Well, that's the psychology today. The market doesn't understand what's really going on, and so when we get into trouble with energy, that means we're going to start losing diesel production. It's going to fall, and that means less mining, less base metal mining. That's going to impact silver more because this is what's going on. The market doesn't understand what real assets are because in the last century plus, Jason, there's been a bid on stocks, bonds, and real estate because of rising oil production. There's been a bid. Got to buy real estate, but real estate, sound investment, home. Well, we're finding out commercial real estate is a disaster, and it's going to become even worse. But soon, residential is going to be a disaster, and then even stocks because they're based on earnings, which is growth. And so the thing is, in the last 100 plus years, the entire psychology of investing is put a bid in stocks, bonds, and real estate because oil production's growing up. Growth is going up. And so that's where you got to be. Well, what happens when oil production starts falling? The bid for stocks, bonds, and real estate disappears. The bid is going to disappear. I'm not saying overnight, but if you're living in a town and there's like 100,000 people and all these homes and businesses, well, production starts to decline. That means less traffic and business activity in that area. Let's say it declines 10% and then 20 and 30. Well, what is that going to do to the value of those businesses and those real estate homes? They're going to fall. And pretty soon I see the next thing that we had a preview during the pandemic shutdown, people moved out of the cities. Well, what's going to happen is I see people are going to be forced to move into one family, move into two. And so you're going to see a lot of homes in the future, suburban homes, they're going to be vacant. And they're never really going to be filled back in. There's not going to be another real estate bubble. This is the last bubble. And so I think these dynamics that I think about all the time, Jason, these things really concern me, and the investors and people don't really see it coming. And I see it coming, even though it's going to take some years to get there. But this is a problem that, unfortunately, oil production growth has put a bid on most stocks, bonds, and real estate. And unfortunately, investors don't realize that all goes away when we hit the energy cliff. And that's why I'm a big believer in owning the physical precious metals.
Yeah, I see a lot of the narrative out there from the main like hedge fund managers and the economists that the economy is going into recession. That's less energy demand, so energy prices are going to stay low. But we're going to go through fits and starts and booms and busts with energy prices, and overall, a lot of the entities are not going to make the investments necessary to bring on new supply, and so we're going to have in the future higher energy prices, potential shortages, and as I think you described in the last couple of minutes. That's going to mean a lot of the consumers and small businesses, more of their spending is going to have to go to electricity, energy, diesel, these types of things. And this is going to affect people's savings, their discretionary income, because they're spending more for the basic necessities for food and energy and these things, which require a lot of energy. And then obviously metal mining, so copper, gold, silver, these require enormous amounts of energy. I think this is something, Steve, that a lot of the people in power in the ESG, and I call it the energy spending grift, they don't understand any of this because they just assume that we can easily replace because they issue new laws that they or give people a subsidy, right? A $10,000 or $20,000 tax credit that people will easily be able to switch from an internal combustion engine car or a diesel engine over to a electric vehicle. Well, I don't think there's enough silver for the global, all these auto producers to go and manufacture electric vehicles for people to completely switch over to electric vehicles. So there's not enough energy at the power plants. Our electrical grids are bad, and there's not enough silver or copper for these electric vehicles.
Yeah, and I couldn't agree more. And to kind of talk about that just a little bit, what's fascinating, where is most of the EVs and green energy being manufactured? In China. And why is that? Because China produced 4.5 billion tons of coal last year, the most ever. And so when you're producing coal, a lot of it in your own country, you have a much lower cost of electricity compared to Europe, where Siemens Gamesa and Vestas are the two largest wind turbine manufacturers in the world. They're having serious financial trouble. Matter of fact, they came out with their Vestas came out with their annual report, and the CEO says, "Well, prices have got to rise for the wind industry to continue to be. The wind industry has to be profitable if we want to continue ramping up the wind industry." And I'm telling you, I'm seeing so many fireworks happening in the wind industry. But it goes back to what is a wind industry, or a wind turbine and a solar panel. That's a fossil fuel derivative. And where is an EV? Where's most of that being manufactured? Most of it is being manufactured in China, where the production cost comes from fossil fuels, comes from coal.
And these lighter electric vehicles too, not only are they using a lot of copper wiring and silver, so a lot more metal, they're also using a lot more plastic. So they're using a lot of plastics, which are petroleum products. There's a lot of chemicals and electricity in the manufacturing. Also the rare earth metals for a lot of the batteries and the other parts for solar panels or wind turbines are all rare earth elements. And the mining in China for rare earth elements is not environmentally responsible. So they're destroying the air, water, and soil too.
Yeah, Jason, and I think by 2025, this is the year, and this is a guesstimation because there's too many unknowns. But looking at all the data, I call the energy cliff really starts to begin in 2025, and we have to understand that word begins. It doesn't. We don't fall off the cliff and then the whole world stops. No, it begins to get really bad in 2025.
Well, the Saudis are going to bring on nuclear power plants, right? So even the Saudis are planning on adding nuclear power plants.
But how long do they take to make those things? And so, and here's the issue: the wind. I looked at what's happening with Next Era Energy, and they're headquartered in Florida. I used to live in Florida when I was younger, years ago. They have the largest wind renewable energy utility in the world. They have all this wind out in the West Coast. They even, in the Midwest, they've got battery, they got wind, even they've got some in Canada. They've got the biggest wind portfolio in the world. You should see the financials. It's a disaster. And so their operating and maintenance cost for their renewables, mostly wind sector last year was $2.2 billion on $3.7 billion in revenue. Now they own Florida Power and Light in Florida, which is mostly fossil fuels, which is natural gas and nuclear, and some solar. They had $17 billion in revenues, and their operating and maintenance cost on that $17 billion in revenues was $1.8 billion, and their renewable was $2.2 billion on $3.7 billion in revenue. It's a disaster, which is the reason why Duke Energy and Dominion Energy have had $2+ billion of impairments on their renewable. And I'm not sure if it was Duke or Dominion. One of them has sold their renewable sector, and the other one is trying to sell it. So this is the problem. I think
so
by
your point here is that it can't be done economically right now. Is that your point?
It can't ever be done economically. It can't ever be done economically. There's no transition to green energy. And so, unfortunately, we're starting to realize that. we're starting to realize that.
Try telling that to the people in DC. They're not giving up. They're going to keep. It's a grift here. They're going to keep growing.
It may be a grift, but I think by 2025, and I'm going to stick my neck out on this. I think by 2025, plus or minus, I think we're going to start seeing politicians, and leaders starting to move away from green energy. There's going to be too many problems. There's going to be too many problems that the government's going to be dealing with, and the financials of because these wind turbines are becoming so big and so complex, they're breaking down. Siemens Gamesa had a huge, they had a net income loss due to problems with it ramping up these larger wind turbines. And now Vestas and Siemens Gamesa, their plan is to go to 15 megawatt offshore wind turbine. The biggest onshore is about 3 megawatts. Now they've been doing 8, 9, and 10 megawatts offshore. They want to go to 15. So it's bigger. It's, there's less of them. Do you know that thing a year and a half ago was going to cost $32 million just for one? But guess what? It's going to cost, the wiring for that on the sea floor is $20 million just for the wiring. So, and then the problem is, once you get that bastard up, you're going to pay $1 million, $1.5 million, $2 million the first year just to service the damn thing. And as time goes by, that complex monstrosity, from what I've looked at the data, the old wind turbines that were a half a megawatt or a megawatt or 1.5, their capex, their operating and maintenance costs were much more subtle. The increase was much more subtle over 10 years. The larger ones have gone up at a much higher rate. And this is
they have to be replaced pretty often too. A lot of the parts, right? Especially if you're in the ocean, you're dealing with salt water and all the wind and all the storms and stuff like that. I mean, solar panels don't even last that long. I think it's a false narrative out there that once you put in these solar panels, they're going to last for many decades. But I think a lot of these solar panels don't even last 10 years.
Well, they are lasting a bit, but they lose the amount of energy that's produced. It becomes less efficient. And it's the same thing with wind turbines, especially the big blades. The outer edge gets worn, and that's especially offshore, like you said, because the salt water mist, and it really erodes these things. And so by 15 years, you got to replace it. The reason why you got to replace it is, well, it's a very complex piece of machine, but the operating and maintenance costs are higher than the revenues you get from the wind turbine. So it's losing.
And you got to go mine all those rare earths in China, and they're destroying the air, water, and soil. I mean, the environmentalists don't talk about this at all.
And you know what's funny? I was looking at Next Era's their depreciation. Their depreciation on their FP&L, which is mostly fossil fuel, natural gas, and nuclear, is 4% a year. And that's right? Because, these things last 25, 30 years, these natural gas plants, even longer. But a 4% is customary. They're doing 4% for their wind turbines. They don't last 25 years. They last 15 at most. So if you figure that they're doing a 4%, actually it's 3.8. If they're doing a 4% depreciation, depletion, and amortization on mostly it's called NEER, that's their renewable sector, which the majority is wind. If they're doing 4%, well, you know what? They're underreporting their true depreciation, depletion, and amortization, which makes them look more profitable. They should be writing off 6-7% depreciation because these things don't last that long. They have to be replaced. And so this is a major problem. I think, and this is my analysis, I think that what's happening in the wind industry, in a lot of these utilities that have wind, they're underreporting their depreciation. So it makes it look like they're more profitable or they're not as bad as what they should be. And this is going to come to roost in the next few years too. So I don't mean to go into all these details, but I mean, I look at the numbers, and the numbers to me tell me, my God, we're in big trouble, and we're going to these renewables and EVs. And guess what? They make the situation worse. If they helped us, Jason, I would say, okay, we may not have the oil to do it, but if you get a wind turbine out there and it lasts you 50 years, well, maybe that's smart. But I mean, they're too complex. They're just too complex. They're not solving any problems. They're just giving us more problems.
Yeah, and China also has basically a monopoly on the rare earth mine supply for now because they're doing it low cost, but they're also like destroying their environment, and then they have a monopoly on the supply, a lot of the rare earth value chain as well. So, Steve, I've kept you for over an hour. I really enjoyed our conversation today. We'll have to have you on in the future for another discussion about mining costs and the energy markets. I think you covered a lot of interesting topics today, but the bottom line, I think people should enjoy cheap energy prices while they last. So we've had this correction here in natural gas prices, maybe electricity bills coming down, diesel prices are going to be coming down in some areas, maybe not everywhere, but some areas. I don't think this is going to be permanent, though.
No, and the reason why is, we talked about this in the beginning, and to just in a condensed nutshell, the central banks really had to do what they had to do, even though a lot of people think the Fed is they're just bat crazy. No, they don't really understand the energy. I'm not saying the Fed does, but what they're doing to kill demand, if they didn't kill demand, we could have seen $150 oil, and then food prices really would have went up. And maybe if you allow the market to do that, the market will solve it. Well, maybe so. But now that we're going back down the other way, it's like a big 100-foot swell in the ocean. The ship's going down the swell. Well, these energy cliff dynamics are going to push us right back up that swell again. And so the next round that I see, which still may take 4 to 6 quarters to get there, when they start doing what they need to do to get, to stop the disaster that's taking place, then we're going to see cost push inflation from energy. I think we're going to see $200 oil. That's coming.
Well, also look how much strategic petroleum reserve oil the Biden administration had to dump on to help get oil prices down. So they dumped a lot of that too. It wasn't just the Fed raising interest rates to try to kill demand.
Yeah, and again, you look at automobile manufacturing and look at the numbers. There's no coincidence that it peaked like in 2017, 18. That's when the world kind of peaked in oil production. And so, even these, unfortunately, lastly, we look at the overall numbers of, they call it barrels of oil. The IEA says we got 100 million barrels of this stuff. It's really not that. A lot of it's natural gas liquids. It's not oil. And then there's biofuels. Well, you can't really make corn ethanol in the United States unless you're burning a lot of diesel to plant and harvest and make the corn ethanol. And so when you subtract all that crap out, we're producing about 80 plus million barrels of crude oil and condensate. And so, but the real crude oil, just crude oil, the conventional crude, that peaked in 2006. That did. It's now declining. And so the good stuff is going down, and we're making it up with this crappy stuff. And so unfortunately, this is where the diesel is the most important petroleum source. And the world, it's not gasoline, so it doesn't matter how many EVs you bring in the world. And we're using less gasoline. Well, the gasoline doesn't matter. It's the diesel that matters. And unfortunately, the diesel is going to be the thing that does the world in.
Well, and I thank you so.
I'm sorry. I don't mean to. People need to. And lastly, if people want to know what's going on, just focus on the inventories in the world, and that will give us an idea. When we see these really start to decline and continuing to decline lower, even though they're going to go up and down, that's what happens as they trend lower and lower. And like the SPR, even though we may build it, I don't think we're going to build it much, and they have to start selling it again. As the energy inventories in the world trend lower, we know we're really getting close to the energy cliff. That's the red warning sign when that's what happens, and that's going to be very volatile for energy prices.
Yeah, but right now. We're dangerously close to the cost of production for a lot of U.S. Oil and natural gas producers. So, I mean, we could see if prices go a little bit lower, we could see a lot of supply start to come offline, and those inventories, like you said, will start to be drawn down because there won't be as much supply online, and then we'll start to see another boom. And then, if the prices fall again, the companies won't make the investments. So that's why we could see these shorter boom and bust cycles with energy prices.
I agree with you. I think these boom and bust cycles could be more extreme, but even on a shorter time frame. I think that makes perfect sense. And so yes, but yeah, uh, even though the Europe natural gas inventories got down to a low last year, now they're at one of the highest levels they've been in a decade. But but again, that's just the first inning, like we talked about. What happens when they get back low again and there isn't the available supply to really pull them back up? And this is like the second, third, fourth inning. Again, this is the first inning of a 9 inning game. But as we go down the innings, these inventories around the world are going to continue to trend lower, even though they're going to fluctuate up and down. When they trend lower and lower, and we lose that buffer. That's when we've really hit the energy cliff, and that's when a lot of this stuff that we're used to in the world is going to change, especially assets.
Well,
So
I think we have lost a lot of that buffer because, like I referred to quite a few minutes ago earlier in the interview, the comments from the Saudi oil minister at Aramco, and he basically said, "Look, we're running at max capacity. We don't have any more spare capacity. So if China comes back online and they start driving and using trucks and their airfare, their flying increases again, the spare capacity is gone from OPEC." That's what he basically said.
and I agree. Yeah, the if we're looking about supply, that energy cliff is talking about the supply of oil, because I hear this. When do you think demand's going to peak oil demand? That's total nonsense.
Yeah, I mean,
Demand.
tell me what the global population is going to be. So if the global population, you mentioned with the 1960s, the global population added billions of people, right? So if we're going to keep adding another billion or 2 billion people every 10, 15, 20 years, it's going to be tough to cut energy demand and electricity demand.
Yeah, and I would imagine uh, I could demand to be a billionaire today and tomorrow and the next one. We can demand to be rich, but unfortunately, reality is you get what you get. And so, demand for oil is supply, not the other way around. It's always going to be the supply. So, really, the demand, the supposed demand, is the available supply, plus or minus, depending on prices and depending on what politics and monetary policy. But that's what it is. So it's really whatever the supply is, that's all you're going to get. That's all you're going to get, folks. And so I think that's the energy cliff. Is we're running out of spare capacity, and that's totally true. The issue comes down to the buffer I'm talking about is the inventories, because we used to have a lot of the electricity in the United States was coal, and we had 90 days, 3 months of coal sitting right outside that coal plant. Well, now we've cut down coal. We're using a lot more natural gas. Well, guess what? We've got about a 30-day supply of natural gas. And worse, in California, it's worse than that because the way it's designed. And so the issue is now we went from a more stable nuclear and coal, and there's a lot of coal there. Now we're at a just in time natural gas and wind and solar, a lot of that. And so the issue is now, Jason, that this system is it's extremely volatile now, and we don't have a lot of backup. And so that's why I'm very concerned about the inventory levels. And so this is when we see these inventory levels decline, trend lower, and then we're kind
So
of.
you're talking about power outages, and you're not just talking about much higher energy prices. You're talking about
That's
potential
correct.
power outages then.
Yeah, well, what's happening in South Africa is going to happen in the United States, and we're not prepared for that. You see, by And this is again, I reflect about these things, and this is not going to happen this year or next year. But due to our transition away from stable coal and nuclear is very stable, to more natural gas and then wind and solar. And the only way wind and solar work is you have to have natural gas balancing plants. You have to have that because the sun stops, solar doesn't work. If the wind stops too, then you're really in trouble. Because if you've added, especially in the Texas ERCOT grid, they've added a lot of wind. If you add 5% wind and 2% solar, if that goes offline, no big deal. And maybe it does help a little bit. Now we're doing 25% wind. We got 10, 15% solar. Now when that stuff is hitting, 40% of your electric supply is coming from wind and solar. And all of a sudden that shuts off. Well, how do you balance that? You got to bring on the nat gas balancing power. You're not going to get it from nuclear, and you're not going to get much from coal. And so I am very concerned that we have transitioned to a different kind of electric generation system that we can't come back from. And so it's not only going to be high prices, Jason, there's going to be shortages and brownouts and blackouts. And this is a dynamic and that's the reason why I think politicians they're going to get away from the green energy. They're going to have to. There're going to be too many problems that they're going to be facing. So I think, again, this is still a few years down the road, but look, it's been 14 years since the global financial crisis. I'd say by 2030, the world we're not going to recognize it. It's going to be a much different place. It's going to be nothing like what it is today. And then every 5 years after that, it just gets much more disruptive because we have less energy to run things. And it's really not about trying to get rid of the politics and go after the remaining energy scraps, as we talked about in the beginning of this discussion. The falling energy return on investment suggests that those energy scraps would bankrupt us. That's the problem. That's what it is. If we try to go more of this unconventional, it'll eventually bankrupt the global economy that needs a much higher energy return on investment from its energy to run it. And that's why we're in all this trouble right now. And so
what the politicians should have done then, and you talk about the Fed just like doing bailouts and papering things over, they focused on bailing out large corporations, banks, inflating asset prices, stocks, bonds, real estate. They did inflate the shale bubble, which kept gasoline and diesel prices low here and cheap natural gas here in the United States low for almost 15 years. But what we should have done was make research and development, like big investments into next generation nuclear power. So instead of spending billions of dollars building a nuclear power plant, it would only cost under $100 million to build these more efficient modular reactors, and we could put them in each city. So unfortunately, that technology is decades behind where it should be because these politicians, when they're allocating capital, have allocated capital into energy. It's been inefficient and heavily politicized, and they've messed things up.
I don't disagree with you. I don't.
The current nuclear power, though, I think has so many problems. So I do like nuclear power now, but it's just not efficient. It's too expensive. It takes too long. I mean, it takes like almost 20 years worth of permitting and millions of dollars in fees just to build one single new nuclear power plant here in the United States. So obviously, it's not going to fix all the problems because it takes too long just to build one plant.
And I'm glad you brought that up. And I don't want to continue to be harboring on negative news, but I did a report on the global semiconductor industry. And it's kind of similar to nuclear because you can't really do nuclear with your uncle in the back, in his garage making parts. You need a very complex global supply chain to supply the parts that are necessary, even to make the small nuclear power plants. And so you need that. You can't do it, somewhere, in Cincinnati. You need a very complex global supply chain to be able to manufacture those parts to make these very high-tech nuclear power plants. If we kind of relate that to the global semiconductor industry, now that you've built this massive fab plant Taiwan Semiconductor. They've got a lot of these, and they build them in the United States. I mean, you should see that. You see the size of these damn things. So now it's open, and so now they're pumping out these semiconductors that are they're supposedly very efficient, and they basically control the entire world as we know it. Right? Semiconductors basically control everything we do. Well, so it looks like that semiconductor fab plant is very efficient. It's not. It's the head of a 2,500-mile supply chain. 2,500 miles. You need to supply that fab plant all the materials it needs to make those real tiny semiconductors that do everything for us. And so the problem is they have a specialized gas facility to process these semiconductors. That's very high tech. And so when you start to understand that this semiconductor fab plant that's built, and so people say, well, now we can continue making these high tech things to run everything. No, when the supply chain starts to break down, and this is another thing people aren't looking at, you lose a few components, that fab plant can't work. And so this is an issue that we've become so complex. We rely on very complex things like semiconductors to do all this stuff. The problem is that semiconductor plant is useless without a 2,500-mile massive supply chain. And when things start to break down, and it's what's interesting. One of the things it needs, is to etch the semiconductor is neon gas, and half of that gas comes out of Ukraine. And so it's very interesting, the situation of complexity that we're so used to. And so even though we could have gone more nuclear, I think the problem is if we look at what's happening with the complex nature of our global supply chain, that we underestimate how quickly it could break down. And this, especially with falling energy production. And this is the very problem I think we need to understand where we're headed. I don't have the answers and the solutions, but I think we're really underappreciating the complexity and the problems we're facing, which is why it would be very difficult to ramp up more complex energy solutions to solve our energy problems. And again, I don't mean to be negative. I've been looking at nuclear, and nuclear has a good energy return on investment, but you have to have high tech to make that work. And high tech's going to get into trouble, unfortunately. And this is the problem the world is facing and doesn't realize it.
Well, yeah, it wouldn't be a quick solution for next generation nuclear power. What I was saying, though, is that people should have seen this coming a few decades ago, and they should have started investing with the scientists for research and development for next generation nuclear. So it would be more efficient. It would be cheaper. It would be less. It would be maybe complex, but also a lot smaller and cheaper and modular. And the goal would be to, instead of spending billions of dollars for one nuclear power plant, to have 10 of them at $100 million or less. And you could just build the nuclear power plant in one single factory with basic materials that were already made. So you could have like kind of that fab plant in one or two factories and just crank out these smaller modular reactors. But unfortunately, that's like something that would probably take decades of research and development and a team of scientists. And so if we started now, it wouldn't be ready for decades. So they should have started this thing decades ago.
Yeah, I do agree. If we were going to do some kind of energy solution, even though I think we're facing an falling EROEI predicament, there are solutions to problems, but there aren't solutions to a predicament. From what I see, we're facing a falling EROEI predicament. But let's just put that aside and say that if we were going to go back 2-3 decades, if we were going to try to do something to fix this issue, this energy problem issue we're going to face, it was wiser to do the nuclear, mini nuclear safe than the green energy. I agree.
Instead, it's both political parties. So you have like George W. Bush and Cheney, and they spent all this money on like corn ethanol subsidies and biofuels. And then the Obama administration took over, and they allocated to wind and solar and biofuels. So no one wanted to actually invest in nuclear. the majority of the capital investment in the energy space here in the U.S. government, the Department of Energy, and the other capital allocation, the other infrastructure, the bullshit infrastructure spending that was wasteful, almost none of it went into actual nuclear.
No, and one of the issues what reviving the nuclear industry is a lot of the nuclear expertise is retired and dead in the United States. And this is I've listened to a few nuclear interviews, and this is the issue. Even and now they say, well, and everyone says China. God, China's over there. They're building all these. No, China is in the same problem everybody else is in. They're doing it cheaper a bit, but they're having cost overruns, and
I've had conversations with the liquid fluoride molten salt thermal reactor expert here in the United States, Kirk Sorensen, and he says a very different picture. He says basically it was intentionally blocked. So he says like the Department of Energy, he says like these large utility companies, they wanted 5-10 years ago to have test pilot plants built, right, for the next generation nuclear reactors for liquid fluoride molten salt thermal reactor, and the Department of Energy basically said, "Go fuck yourself." So,
well, this is definitely up for debate, and I've seen some information from people in the nuclear industry that said that the technology for liquid sodium reactors really has not been solved yet, and let's just say it was. It's still a couple decades away. We could, and here's the issue. Let's say we started 2 decades ago, and now we could start making them. Well, we're going to start heading down the energy cliff. Even if we started making them, which is probably a smart idea to do, we're going to hit the energy cliff.
But didn't supposedly wasn't over $1 trillion just spent on infrastructure, and I don't think any of the infrastructure problems were just all because what the press release says, almost $2 trillion in infrastructure spending from the Biden administration, 18 months ago. So that money could have been used to build these modular reactors, but it should have started decades ago. So the whole thing, all these infrastructure projects are just a scam. The money doesn't actually go to fixing the infrastructure.
Oh, and do you know something? And I agree with you more on just about everything. And all I'm trying to show is we're having so much trouble with this falling energy return on investment. These solutions that we think are going to be solutions are really not, even though some are better than others. I would say that the issue is this. You just brought up something, and I don't mean to continue we're still talking, but this is kind of important for people to know. Even if we add all these mini nukes, or we add all this wind and solar, we're putting this brand new shit on. Well, we're putting all this brand new stuff on an old shitty system, right? And the $1 trillion is supposed to be spent on infrastructure. So now you've got all this aid. You see, here's the issue that we really overlook. We have all this infrastructure. It's in different stages of falling apart. And we try to continue maintaining it. But the bigger it gets, the more you got to maintain. This is another issue that's totally we're overlooking. That all has to be maintained.
Yeah,
so even if you put in a brand new, nice mini nuclear power plant, you've got to replace that asphalt or that cement road. Or you got to replace all these electric lines. All that stuff.
The power grid's a mess. A lot of it was built post World War II, right? So, and then it was it's repaired with bubble gum and duct tape.
And the water, the sewer, phone lines, it goes on and on and on. And so this is the issue, Jason. There really aren't any good solutions. There's unfortunately too many big problems coming. And so it's
just very frustrating though, because I've been here in DC for over 20 years and we see, it seems like every 4 to 8 years, there's a headline, new infrastructure project, right? 800, the amount of money supposedly being spent on infrastructure, the headlines just keep getting larger and the infrastructure doesn't seem to be improving at all.
No. I agree, because if you start adding up what needs to be done, and they talk about, this is what they say, we're going to have to spend 2.5 trillion to get this up. And you see, and what they're talking about is money. what we need to, how much, if you take that 2.5 trillion and then you make it into oil equivalent, how much energy you got to burn to do that? This is the issue. It was easy when we grew production to expand infrastructure and to replace it, kind of maintain it. Now, when you're peaking and falling over, you don't have the energy now. You're losing the energy supply. So when someone says we're gonna spend $1 trillion, no, how much is that in energy you're gonna spend? Let's get rid of the dollar amount and let's instead put in how much energy you're gonna spend. That's really what it is, right? And we don't have the energy really in the future to do that. And so this is, but you're right. It's fascinating when you get to this peak of civilization, you get more stupidity running it. That's unfortunately the result.
So yes, well, the polling is that American people, if the government is going to spend money, they support infrastructure spending. So you see these headlines, okay, the money's going to infrastructure. Well, show me itemized, show me pictures, videos of all the construction that the money for all these supposed infrastructure projects to replace things or upgrade things is actually being used efficiently. And the truth is that almost none of the money is being used efficiently on an infrastructure. So on these bills, almost all the spending, it's being stolen or a lobbyist or another government agencies adding things into the bill, and the money's actually, so that the headline number over $1 trillion in infrastructure, whatever, only a tiny fraction of it may actually be used for infrastructure that people said actually either replace something that needed to be replaced or improve something in infrastructure. That's how messed up the system is. It's just, they're just printing and papering over stuff to maintain the size of the government and bail out corporations and banks and stuff. That's the financialization bullshit that you were describing earlier.
Yeah, and I agree. And I think if the government was honest and did an accounting on what needed to be replaced, and the costs of that, it would shock Americans. It'd be very depressing. And so you start to go in some of these old cities and major cities, you see the bridges and everything's kind of like falling apart. Now, we do have better infrastructure in a lot of countries around the world. You go to some of these countries, and my God, I mean, you see, like in India, some of these trucks that they run on these roads out in the middle of these mountains. It's like, oh my God, you take your life in your own hand in some of these places. So we are better, but we have so much infrastructure that what it's going to take to fix it, it would scare Americans, and we just don't have the energy to do it. And so this is, again, we've faced so many problems, and there aren't really that many solutions. So I think in a nutshell, to conclude, what I think your listeners, they should understand what we're facing and figure out how to, if these things are going to happen in the future, and I think they are, then how do you position yourself to weather these things that are coming the best way you can? And so when someone's out there protesting, they got a sign and they're out there, I'm going to protest against this asshole, you're wasting your time. What you need to be doing is to figure out where you're going to live or wherever you're living, and you get with a group of people or a local farmer, and you've got to figure out how you're going to weather what's coming. That's where we need to spend our time. Even though I spend a lot of time on the computer, I do this other thing as well. So if people think they're going to go out and protest, you're wasting time. That's a waste. You've got to take control of your life and figure out what you, your family, or your area is going to do to weather the things that are going to happen in the next 5 or 10 years. And I think that to me is the best thing for people to start to think about.